everyone, how we doing today? In this class, we're gonna go over velocity banking and cash out refinancing. Does it make sense to apply with this strategy to rapidly pay off debt? Can it be a reasonable tool to look into in the event you can't get a line of credit, or you're not eligible, or you applied, got denied too many times, credit's not there, dealing with bankruptcy, many different situations, right? So on the board here, I have a client that I've been working with, and what I really enjoy when I'm working with my clients is the amount of information that I can learn from them, okay? So it's not always me that's gonna have all the answers for your situation. There are some of you that are coming to the playing field with a situation or scenario that I may have never been a part of, never seen. You're going to be like an isolated case. And so this client right here, she's an example of that, of an isolated case that I have not been through just yet. I've never done a cash out refinance myself, so I'm not going to have all the answers, but what I can do is run the numbers, right? As long as we run the numbers together and we combine our minds and think as one for your goals, for your financial goals, we're going to get there, right? You just got to run the numbers. And on this channel, that's all we do all day long, is run numbers, work out the scenario to see if it makes sense, right? So velocity banking and refinancing. Here is the scenario. I didn't lay out her income or numbers because she's got varying income, right? I've got clients that have business income, personal income, and dividends and profits and things like that. So I'm not going to really focus too much on her four majors. I want to focus on the refinancing. Does it make sense for what's going to be going on, for what she told me that she wants to do? So we've got this current mortgage, which is right here. Got a current mortgage, $125,000 owed on it. The value is $180, and the payment is $1,250. Now, with the cash out refinance strategy, she would be getting a new mortgage of $200K, I believe, if I'm doing this right. I'm still learning, and for my people out there that are real smart, that know about this, you can definitely comment below and let me know your thoughts on combining the two strategies. So she would refinance the mortgage into a $200K, which she would receive anywhere from $65,000 to $75,000 cash, right? So we pay off this mortgage, we get a new one for $200,000, and the monthly payment drops from $50, okay? So cash flow would go up $50 from there, and I have this big lump sum of money that I can use to do velocity banking with, okay? We don't have a debt tool, okay? Her only debt tool is she does have credit cards, and she has a cash value life insurance policy that she is currently funding. It's a new policy, not that old. And so we've got those two tools, all right? Now, her thought was, now she is a real estate investor, she has multiple properties. So she was thinking, hey, if I took a portion of this and paid off another mortgage, a separate mortgage for $55,000, her cash flow is gonna go up $600+ because this current property that we would be paying off is paying her rent, right? And then that rent goes towards paying the mortgage. So by wiping that out, I get a cash flow increase of $600+, and I get that $50 right there. So of the 65 to 75, 55K goes towards paying off the mortgage. The rest of the money is going to pay off 7 different credit cards, okay? Which is option 1. The rest of the 50, what's left over from minus 55. It's going to be anywhere from like 10K at least, right? So it's going to be left over. So I based off my numbers off the 10K for her. And we were thinking, okay, we can, option 1, throw that cash directly at the 7 credit cards, or she can put that 10K first into her life insurance policy based on her MEC, okay? I believe she has a MEC of 10,000. We haven't figured it out just yet. She has to contact the insurance agent that she worked with to find out what that number is and then how much she can add into PUAs for that specific year, right? So if we threw the extra money into the policy and then borrowed against it to pay off the 7 credit cards, that would be a better effective use of our money, right? That would be a more effective way to leverage and use the money twice, okay? Overall cash flow rises, then we can do velocity banking on another credit card that she has, which is a Bank of America credit card, has a outstanding balance of about 20,000 or less, right? So we owe 20,000 on this Bank of America card. After doing all these moves right here, our cash flow goes up 600 plus. Very conservative, probably be more than that, maybe like 700 or so after these 7 credit cards are wiped out. And they're fairly small monthly payments. We're talking 35, 25, 35, small payments. But the beauty is I wipe out 7 credit cards. So my credit score is going to jump, okay? It's going to put me in a better position where anywhere from 3 to 6 months down the road, I can go and do what? Apply for the line of credit, right? So we had to, do something that we may not love, okay? Because I don't love this strategy, okay? This is not something I would recommend to every one of my clients that has a mortgage because they're thinking this, big lump sum of money. Well, hold on, okay? If you're not a business owner, if you don't have properties, assets, if you don't have prior knowledge, this is not for you, okay? Because I am not going to be able to provide you with that expertise on this right here, right? Because it's not something that I practice. It's not something that I will practice anytime soon, right? Because I have my own way of doing things. But I'm always willing to be open-minded, even in my own ways, to see, does the math make sense for this particular situation? Her income is 10K plus. That plays a factor, all right? Her knowledge plays a factor. She's a business owner. She's a real estate investor. Those are some key factors that play a role in my guidance when I'm working with my clients, right? So if I had someone in the same situation, has no prior knowledge of refinancing, never done it before, they don't have assets, they don't have a business, you've got no business trying to refinance, right? Because this is also a tax strategy. This is a tax strategy. She'll be able to write off some of this stuff. When she pays off this mortgage, that's going to be a tax strategy. Depreciation, appreciation, different things, okay? There's going to be tax strategies on the back end of this on top of velocity banking, right? So in a nutshell, we are going to practice this refinance strategy. We're going to have this new mortgage debt, which is something that I still don't love, but for a short-term result to get me here, I'm willing to do it for this isolated scenario, right? Isolated scenario. Cash flow goes up 600 plus after it's all said and done. My credit score will definitely go up over the next 3 to 6 months. And then I have a debt tool in place that I can leverage, which is a credit card. I can start using that. So what's going to happen is that 20K balance of the 10,000 she makes, a portion of that is going to go on this credit card, right? Whatever expenses that I can pay with the credit card is going to go on here, right? So the income that she makes, of that income, we're going to break down the expenses, right? We're going to see, okay, what needs to stay in cash to pay cash bills? And then what is the number over a 30-day period can I run on the credit card? I get that number, I add that number, and I add the monthly payment, right? The monthly payment on this card. Now I got 3 numbers, add them all together. That is my chunk into the credit card first, right? Which what? Brings the balance down, right? Then I use a portion of that same money to do what? Pay my bills, run expenses through the card. What happens now? The balance goes up. What stays in is 100% of this and 100% of the monthly payment. I cut off the interest rate from accruing on 20,000. Now I'm only going to have interest accrue on maybe 17 to 15,000 because of the amount of money I put in. And because I put that money in first before I use the card, it satisfies the month's payment for the month that I'm in, possibly even the next, right? Because of the due date, the closing date, the statement owed on the credit card. So depending on where I'm at in the month, I immediately put that portion, that chunk, onto the credit card for the month, whether it's all at once or if you get paid weekly, so maybe 4 times a month, or if you get paid bi-weekly 2 times a month. That money's going into the credit card. Her situation, I think she gets all her money at once for the most part within a certain time frame. So all that money will be able to go into this card. She's going to cut off the interest rate from accruing on next month's bill. So she only pay interest on somewhere around 17 to 15,000, right? By the time the balance rises on the credit card due to expenses that we already pay for, what's going to happen over 30 days? Well, I'm going to make money again. And I prepare my next chunk. So by the time I've ran all my bills through that card, I'll replenish it with the new money, new cash flow, new monthly payment. The monthly payment already got satisfied for the following month and the month that I'm in due to the speed at which we pay things, the velocity effect, right? So, in a nutshell, refinancing can potentially work for some of my clients, okay? I liked it in this situation. I didn't love it, but I liked it. It worked. The math made sense. The numbers make sense. I pay off one mortgage. I refinanced another. The monthly payment does go down. I still need to keep an eye on that, right? Because I just restarted all the interest on that. That's the only thing I don't like about it, is I restarted all the interest that I've paid from 180 to 125. It got all restarted again. So I need to make sure that when I'm running the overall numbers, that no matter what, I still will become debt-free within a 5 to 7 year period or less than that, according to her income, expenses, debt, cash flow, debt tool, key factors. All right. My name is Denzel. Hope you enjoyed this video on velocity banking and cash out refinance. If you want to work with me, if you want to get more information, I have a ton of resources in the description below. Check it out. Check out my website. Subscribe, like this video, comment. Let me know your thoughts. God bless you and have a wonderful day.